Hello everyone, my name is Andreas Thalassinos and I would like to welcome you all to today's webinar titled Trading with Popular Chart Patterns. Please type yes if you can hear us, if you can see our screen. Just give me some feedback, please. Type yes, okay, anything you want to give me some feedback so I know that you can see our slide and you can hear our voice. All right. Okay. So we get a lot of yeses. That means we're up and running. Let's go through the agenda for today. Of course, we're going to remind ourselves Dow theory. It's one of the most important theories in technical analysis, and a lot of concepts are based on Dow theory. Then we are going to talk about double top, which is a reversal, trend reversal. And we're going to talk about the incomplete double top because we don't really want to follow an incomplete double top, but rather we want to see a complete double top that signals the end of the trend and the beginning of the trend in the opposite direction. And of course, I will show you the bull trap as it's called, bull trap, and then I will go on with double bottom, which is very similar to double top, of course, but in the opposite direction. Incomplete double bottom and the bear trap. Then we will move on to triple top, triple bottom, and then we're going to explain head and shoulders. Head and shoulders is considered one of the most reliable reversals in technical analysis. And then at the bottom, we call it inverse head and shoulders. And I will show you how to calculate the minimum price target or price objective, as is called in technical analysis terminology. And then, of course, I will incorporate Fibonacci levels to construct trading strategies. Anytime you have a question, please post it, write it, and then my colleagues here will translate them for me if it's in Farsi, and then I will reply to you if I know the answer. All right, good. So Dow theory, let's remind ourselves that when we identify, when we spot higher tops and higher bottoms, then what we have on our screen is an uptrend. The minimum requirement is two tops higher than each other, two bottoms higher than each other, and price moving higher than the last top. This is the minimum requirement for an uptrend. And this is Dow theory. And we can go on. And of course, let's touch on downtrend based on Dow theory. Successively lower tops and lower bottoms. And the minimum requirement is two tops lower than each other and two bottoms are lower than each other, and prices fall below the last bottom. Then when that happens, we are officially in a downtrend. Okay, let's go on. Double top. So when we identify an uptrend, that uptrend will continue to move higher and higher, creating higher tops and higher bottoms until we identify a reversal. A reversal reverses the trend. It's very important to understand that because you cannot identify a reversal in the range. Reversal reverses the trend. So double top means that we have two tops about more or less at the same level. They don't have to be exactly the same, but as long as this second top is equal to the previous top or lower, not higher, then we have two tops. But we do not have a double top yet. A double top will be in place when prices fall below the bottom. Now we have a double top. This reversal, this double top, signals the end of the uptrend and the beginning of a new trend in the opposite direction, a downtrend. And usually this is the very early stage of a downtrend, and a lot of traders will open a sell position here. Measuring technique. So again, we have a beautiful uptrend. We identify two tops and we wait for the double top to be formed. Double top is formed once the price falls below the bottom. When that happens, traders initiate a sell order here and they can estimate the minimum price target. How do they do that? They take the height from the highest top to the last bottom, and they project it at the breakout level. This is the minimum target that prices will go. Is the minimum. They might go even lower, but based on this theory, this is the minimum target. Some traders use this concept of minimum target to close part of their position. Okay? We go on, and of course, this is a snapshot from a real chart just to show you that this is a beautiful double top, which is very similar to our slide. Incomplete double top, of course, the prerequisite for any reversal is the presence of a trend, and in this case is the presence of an uptrend. Yes, we identify two tops, but the double top formation is not there yet. What is needed is that prices fall below the last bottom. So as long as prices are not lower than the last bottom, then what we have is an incomplete double top, and you are not allowed to do anything based on this pattern because simply the pattern is not there yet. Excellent. Bull trap. This is trader's nightmare. This is how I call it. Let me show you. We have a beautiful uptrend, and then we identify two tops, and then prices fall below the last bottom. So we expect prices to fall even lower and lower. So traders open a sell position here. And then what happens? Prices go in the opposite direction. This is exactly what we call a bull trap. Yes, you get a signal to sell here, but then for some reason, prices go in the opposite direction. This is a very good point in time to emphasize, to stress once more the importance of stop loss. So you see that no strategy, no system, no method, no plan is 100%. That's why we need to place stop loss right here. Just in case. You never know what is going to happen next. Double bottom is similar to double top, but we find it at the bottom, at the end of a downtrend. So based on Charles Dow's theory, we have lower tops and lower bottoms. And of course, this is a beautiful downtrend. And this downtrend will continue to go lower and lower until we identify a reversal. Yes, we see two bottoms, and then prices move above the last top. Now a double bottom reversal is in place and it signals the end of the downtrend and the beginning of a new trend in the opposite direction, which is actually an uptrend. Many traders will open a buy position here and they will place at this bottom here, the last bottom, a stop loss, just in case. Okay, excellent. We go on. Double bottom measuring technique. Again, you see the presence of the trend, of the downtrend. Never forget that is very important. A prerequisite is the presence of a downtrend. And then we see the two bottoms and prices moving higher than the last top. Now, a reversal is in place, a double bottom is in place, and a lot of traders will buy at this level right here. And of course, don't forget to place your stop loss at the last bottom. And to identify, to estimate, to calculate the minimum distance that prices will move upwards, then you take the height from this top to the lowest bottom and you project it at the breakout level. So here is the minimum distance that we expect these prices to move higher based on the double bottom theory. Okay, excellent. We go on. If you have any questions, please post them and I will try to answer them. We go on. Bear trap. Bear trap. We have a beautiful downtrend. We identify two bottoms. Prices move above the last top. So a double bottom reversal is there, is in place. And then a lot of traders will buy here. Never forget to place a stop loss here because you never know what is going to happen. And sometimes this is going to happen. Prices, instead of moving higher, they go lower. And this is what we call a bear trap. We have a question here by our friend, Mr. Emmanuel. Mr. Emmanuel, where are you from? Just give me your origin here, please. Emmanuel, the question is, what is stop loss? Very simply, when we enter the market with a buy order when you buy. For example, you buy here, yes, the probability is that prices will go higher, but is it 100% sure that prices will move higher? Of course not. That's why if prices move in the opposite direction and go lower, we do not want to lose our whole account. We want to just lose a small amount of our money. That's why we place a stop loss here at the last bottom. So if prices go in the opposite direction, we're going to get out of this buy position with a pre-calculated loss. Okay? All right, Mr. Emmanuel from Ghana. Thank you so much. I haven't been to Ghana yet, but I hope soon I will come and have a seminar, hopefully there. And maybe I will meet Mr. Emmanuel. What time frame is best in analyzing the trends? Adedoyin, where is Mr. Adedoyin from? And the best time frame, of course, is the best time frame for you, because it has to do, the time frame has to do with your own occupation, the job that you have. If you are a surgeon, a medical surgeon, for example, and you are operating on a patient, you cannot stop this surgery to buy Euro USD. So as you see, a low time frame is not best for this surgeon. If you are a judge, for example, you cannot stop the court to say, let me buy gold. You see, again, the job that you have will affect the time frame that you trade. If you have 3, 4 children in the house, especially young, and they run around, they have to go to sleep first before you start trading. You see, your job, your life, your family, your lifestyle, your commitments, your social commitments will define your time frame. Okay? But technical analysis works equally well on a low time frame, on in an intermediate time frame, as well as on a high time frame. Choose the time frame that you feel good and go ahead and trade. Okay, Mr. Adedoyin, where are you from, Mr. Adedoyin? Lagos, Port Harcourt, Abuja, where are you from? Thank you. We go on in complete double bottom. Never forget that we do not want to trade incomplete formations. We care only to identify complete reversals. So this is a beautiful downtrend. And then when we spot two bottoms, it's not enough to call it a reversal. To have a reversal of this downtrend, you need two bottoms, but also we need the prices to move higher than the last top. And this is incomplete double bottom. And as technical analysts, we're not going to do anything. There's no reversal. Very good. We go on. And this is a snapshot from a real chart. You see that is a beautiful double bottom, and it looks like that, just like our slide. Okay, we go on. Triple top. Not only two tops, but also three tops. So we have the first prerequisite, which is a beautiful uptrend. as defined by higher tops and higher bottoms. This is Charles Dow's theory, after all, of defining trend. And then we identify three tops at about more or less the same price level. About more or less, because they cannot really be at exactly the same price level. It's not really needed. And then the three tops will create two bottoms. And when the price falls below the two bottoms, then we have what is called a triple top reversal. Triple top reversal. And this signals the end of the uptrend and the beginning of a new trend in the opposite direction, which is, of course, yes, you guessed it right, it's the beginning of a downtrend. Okay, we go on. And what is the minimum measuring technique? Okay, we have few questions here. Actually, one. Okay, what are the chances of this strategy to go in the predicted direction? Yeah, these reversal patterns, um, double top, double bottom, triple bottom, and other ones that we will see in a while, they are all referred in technical analysis books, and they have been studied in historical prices, and they found that when you identify these patterns at the end of a trend, chances are that there is a reversal. A lot of studies have been done by different people, and they found that chances are that indeed there is a reversal. But again, what is a reversal? A reversal is a reversal, a new trend in the opposite direction with successively lower or higher tops and bottoms, or is it the definition of prices reaching the minimum price target? Or perhaps is the definition of giving you more than the minimum price target? You see, there are a lot of explanations of what is meant by going in the predicted direction. How far? You see, how far you expect it to go. So it's easy for me to say, yes, it will go in the opposite direction, but again, it doesn't mean anything. Is it going to go in the opposite direction for few pips, 5, 10 pips, or is it going in the opposite direction 100, 1000 pips? Okay, the answer is nobody knows exactly how far it will go, how many pips. It's only an estimate. Okay, and as we go on in this presentation, I will introduce you to a new technique, another technique, how to calculate price targets. And then perhaps it will make sense. Okay, let's go on. Triple top. Again, we have a beautiful uptrend. And then we have one top, two tops, and three tops. Now, we expect prices to fall below the bottoms. And when that happens, we have a reversal. So traders will initiate a sell position here, and of course they have to place a stop loss at the top, just in case, because you never know what is going to happen next. And then of course, to estimate, to calculate the minimum distance, then we take the height of this formation and we project it at the breakout level. You see, this is the minimum distance based on this theory. So this theory implies that prices will go at least until here, and at other times it will go even lower. That's why it's called minimum distance. And here is a real price chart. Triple bottom, just like triple top. At the top, we have triple bottom at the bottom. The prerequisite is a downtrend, and of course, we indeed have a beautiful downtrend here, as defined by lower tops and lower bottoms. And then, if we identify 3 bottoms, which create 2 tops, and prices move above the tops, then we have a reversal in place, and this reversal is called triple bottom. Now, the measuring technique for triple bottom is again the same. We take the height of this formation and we project it at the breakout level. And this is the minimum distance. Very good. We go on. Triple bottom on a real price chart. Head and shoulders is based about more or less on these concepts that we just have explained. And is considered one of the most reliable reversals. This is what is written in the textbooks. So let me show you how it goes. We have successively higher tops and higher bottoms. So what we have in place is an uptrend. And then we see this formation where we have this top, another top, and another top right here. The highest top is called head. The one to the left is called left shoulder, and the one to the right is called right shoulder. That's why this reversal is called head and shoulders. Now, this head and shoulders pattern forms 2 bottoms. Do you see these bottoms here? By connecting the 2 bottoms, what we actually get is what is called the neckline. When prices fall below the neckline, then the head and shoulders formation is in place. And traders will sell here when prices drop below, expecting prices to go lower and lower, and place a protective stop loss at the top, which is called right shoulder. Why place a stop loss? Just in case. Nobody knows what is going to happen next. Okay, we have a lot of questions here. My name is Yo from Ghana. Which indicators are simple to use and reliable in your opinion? Yo, I will give you the best indicator in a while. Then another question, candlestick that breaks the support and resistance line. Please explain about this. Ali is asking. What is breaking the support and resistance? So you see this candlestick that falls below the neckline or below the support if you like, then we say that prices break the support. This is what we mean. How I am sure bottom or top are double. You look at them and you realize that about more or less they are equal. You don't have to take a measuring tape. Okay? Farshid is asking, how can I recognize a sell trap or a bull trap, right? How do I recognize whether I have a bull trap or a bear trap? You will recognize it after it happens, unfortunately. This is the time that most traders will lose money. If you're trading the stock market, then you will have an additional indicator that perhaps sometimes will save you from entering a bull trap or a bear trap. And unfortunately, volume is not available in Forex, so we cannot use that information. So we go on and we have another sentence here says, oh my God, this is trouble. Your education is very, very sample. This is shame. Javad. Is it good or bad? Mr. Javad, what do you mean? Which time frame is good for finding patterns? Sadek? Any time frame. The answer is any time frame. And another question from Tisan from Nigeria. How far from the breakout should one place a stop loss? The stop loss that we use on these patterns are technical stop loss. It's technical. Technical means that if we sell here when prices drop below the neckline, then it makes sense that our stop loss will be just above the right shoulder. Okay? So we do not measure pips. We place our stop loss at the technical level, which is this right shoulder. Okay, Mr. Tisan? All right. I think I answered all questions. Javad, I don't understand your comment about the trouble. Please rephrase it. So we go on. Head and shoulders measuring technique. Beautiful uptrend. We identify head and shoulders. Prices break the neckline, fall below the neckline, breach the support, whatever you're going to call it. So this is the end of the uptrend and the beginning of a move in the opposite direction. So traders will sell here and place a stop loss at the top, at the right shoulder. And According to this theory, if we take the height of this pattern and we project it at the breakout level right here, then this is the minimum target that we expect prices to go. Okay, guys, so you see that this measuring technique is present in all these reversal patterns. All right. We have a long question here, and let me read it. My name is Homla from Johannesburg, South Africa. I understand that each pattern has to appear after a trend. This is absolutely correct. These patterns appear after a trend. This is the prerequisite. Very good. Should I wait for the price to go above the second successive top, or it doesn't matter as long as it is an upward move? Okay, the question is, a prerequisite for these reversal patterns is the presence of a trend. So what he's asking actually is, what is the definition of a trend? The definition of a trend for technical analysis is the presence of two tops and two bottoms higher than each other and price going above the second top in order to have an uptrend. So as technical analyst myself, I cannot suggest anything else. Now it's up to you to decide whether you want to call it a head and shoulders without two tops and two bottoms higher than each other. But in technical analysis, concepts and theory, this is the definition of the uptrend. We have another question from Mr. Godfrey. Can we identify these reversal patterns from the oscillators? If I understand the question correctly, is are oscillators synchronized with these reversals? The answer is yes and no. Sometimes they are synchronized, sometimes they are not. One of our colleagues a while ago asked me which one is the best indicator, best oscillator. And I replied, I will give you the best oscillator in a while. So perhaps this is the time to reveal to you all the best oscillator, the best indicator. So if you are ready, the best indicator is price, nothing else. Anything else is secondary to price. Do not forget that oscillators and indicators have delay in their signals compared to price. Okay? Piercing candles, please. Yeah, piercing candles they are out of the scope of this seminar today. You can go on our website, Mr. Ali, please, and download 2 of our ebooks that we have there for you, absolutely free to download, and you will learn about piercing line and dark cloud and many other formations. It's absolutely free for you to download our ebooks. Another question is from Sadek. Do I pronounce the name correct? Sadek? Sadek? Yeah. This pattern is mostly used in what currencies? Or really doesn't matter? Sadek, you know the answer. It doesn't matter. Any currency, any stock, any index, any commodity, any precious metal, anything, instrument, any instrument you can apply it on. Question from Avdap. What time of day is better for trading? It doesn't really matter as long as you identify the trend and then you spot the reversal, it's very good. Okay? Another question by Ali. Could you clarify on a right shoulder? I place stop loss on my sell position. Okay, actually, our friend Ali says, what do you mean place stop loss? So I sell here, guys. I sell here when the price drops below this neckline, when the price drops below this support level. So I sell here. Now, am I 100% sure that prices will go lower and lower? No, nobody's 100% sure, because there is no such a thing in trading 100%. So I place a stop loss. Stop loss, it's an order that you can find on MT4 trading platform that you can use to get out of your losing position. Okay? And another question by Sadek. Profit of this pattern is different for currency pairs. Okay, listen. From currency pair to currency pair, from head and shoulders to head and shoulders, of course it's different. It has to do with the height of the head, of the right shoulder, the left shoulder, the day, the time, the day, the news that are coming or they came out, so many parameters. But the theory is the same. And this is the most important thing, that we have a concept, a theory, a system. What I'm giving you here is a whole system, actually. I'm telling you the entry in the market, where to place the stop loss, and I'm showing so far the minimum price target according to this theory. Let's go on. Measuring technique, we covered that, and now we move on. Measuring technique again. What is that? Look at that. You see, again, head and shoulders, head, left shoulder, right shoulder. But by connecting the two bottoms, you see that this neckline is not straight, is not horizontal, has inclination, a slope, downwards slope. It's skewed downwards. So, again, the measuring technique is very simple. You take the height of this pattern and you project it at the breakout level. Anything else is the same. You sell here, stop loss is at the right shoulder. We have a question here by Godfrey. Are the measuring techniques discussed so far in sync with Fibonacci? This measuring technique doesn't have to do anything with Fibonacci. Fibonacci is a different concept. This measuring technique is a different concept. But you can use Fibonacci to calculate your potential profits if you wish. Another question by Ahmad. When can we say that the neckline has been broken? You can say that the neckline has been broken when it penetrates few points if you are trading a low time frame. If you are trading a higher time frame, let's say daily or weekly, perhaps you can wait few pips, right? Okay, and one more question here. How to calculate the speed of one trend? Mr. Souflazet, I'm sorry about the pronunciation. How to calculate the speed of the trend? Okay, the speed. I don't exactly know what you mean by the word speed. Um, if you mean momentum, perhaps, then we have a momentum oscillator that you can use that it may also confirm the breakout of these patterns. But the speed I don't really understand. As long as the price moves in the correct anticipated, I would say, anticipated, expected direction and reaches your expected take profit levels, this is fine. Sooner or later, as long as it goes there. I know that you want the price to move very fast because it will boost your confidence and will take away the stress. Okay, we go on. Measuring technique, another pattern here. You see that in this case, again, we have a head and shoulders, but this time the neckline points upwards. And the breakout is exactly where the candlestick price falls below the neckline. And the measuring technique is to take the height from the head to the neckline and project it at the breakout level. And this is the minimum distance. Another question by Mr. Mohammed. Is the right shoulder, does the right shoulder, should the right shoulder be higher than the left shoulder? And not necessarily. Not necessarily. We have a head and two shoulders. Okay. And another question by Hlomulani. Hlomulani. Hlomulani, where are you from in South Africa? If you tell me where you are staying in South Africa, I will tell you when I will be there. Until you type your location, Exxon. Mr. Andreas, please give us a fixed number of pips for stop loss. Exxon, I cannot do that. We do not use fixed pips stop loss. We use technical stop loss. And the technical stop loss is after you enter the market. In this case, price falls below the neckline. Then we place a stop loss at the last top. In this case, at the right shoulder, because this is the technical stop loss. So Holomunali doesn't want to reveal his city. Nevertheless, I will tell you. Thursday next week, I will be in Cape Town for workshops. I hope I see you there. Oh, Johannesburg, come to Cape Town. I have workshops there. Okay. Visit our website, please. Check our webinar page, our seminar page, and you will find out our next educational event near you. Okay, inverse head and shoulders, just like all the other patterns, we identify a downtrend and then we see inverse head and shoulders. Our head, left shoulder, right shoulder, prices go above the neckline. And of course, we have to place here, right here, just below the right shoulder, a stop loss, a protective stop loss. Okay? Measuring technique, absolutely right, all of you. We take the height of this pattern and we project it at the breakout level. That's it. That's the minimum. Okay. Very good. And measuring technique, of course, you see we have these different head and shoulders. I mean the neckline, actually, this is what is different, which is very similar to the head and shoulders. Again, the measuring technique is projecting the height of the pattern. And one more. The neckline, you see, it moves downwards, and the measuring technique is by projecting the height to the breakout level. And this, of course, is the minimum price target. Double top strategy. We know the double top strategy, right? Two tops about more or less at the same level, and then prices fall below the bottom. Then what? We can use the Fibonacci to identify potential take profit levels. We click on the Fibonacci icon, then we attach Fibonacci at the bottom and we drag it to the top. And if we do it correctly, we get 161.8, 261.8, and of course, one more level, 423.6 is not shown on our slide right here. And then when the prices move to these potential profit levels, you can close part of your position. Double bottom strategy is very similar. Again, we click on the Fibonacci icon, we attach our Fibonacci from top to bottom, and we get again three take profit levels, 161.8, 261.8, and 423.6 is not shown here. And from a real chart, this is a real chart. This is the double bottom here, guys. Bottom, bottom, top to bottom. And you see 161, 261, 423.6. And also I show you the minimum price target according to this technique. So perhaps you can either follow only Fibonacci, you can follow only the price target, or you can blend them. You can use both of them. It's up to you. So many ways to take the profit. And I can give you more information here. You see our double bottom, we buy here, but before we buy, perhaps we need some extra confidence. That's why we use our momentum oscillator. And if the momentum oscillator is above the 100 line, then we feel more confident to buy. Similarly, head and shoulders, guys, left head, right shoulder. From bottom to top, we draw the Fibonacci 161, 261, 423, 6. You see entry in this case is a sell, stop loss at the right shoulder. Never, never, never forget that. And if you want to use also the minimum price target, you can use that one or the Fibonacci or a combination. And again, the momentum oscillator, you see, is to confirm our decision. Again, similar situation, but instead of having momentum, now in this case, we use the MACD. MACD, when MACD, these gray bars are below the signal line. If you are not familiar how MACD works, we will explain this in another webinar that we're going to have soon. But again, the same concept here. And again, inverse head and shoulders. Now we combine not only MACD, but RSI as well. RSI being above the 50 line and MACD being above the signal line. RSI only, you can use RSI alone. Again, the same concept, we buy here when prices break above the neckline, and never forget the stop loss, in this case just below the right shoulder. And something new here that I introduce also an indicator, a moving average, this red line, you see, to give you extra confidence to buy here. RSI, it's above 50, and also the price that breaks above the neckline is above the moving average. So the best indicator price suggests that we go up, then this is confirmed also by the moving average and the RSI. Now I feel more confident. And that is that. I have few questions here. Candlesticks may be fast, but we get more wrong signals. Am I right? So what is the alternative? If candlesticks are not good, what is the alternative? Arash, my friend Arash that I met in Armenia, is this the Arash that I know? Do we have a divergence in the technique of head and shoulders? Arash, no, we don't use divergence in this webinar, but if you feel like using divergence, feel free to use them if they make you feel more confident. But again, do not rely on the divergence only, rely on the price, not the divergence. Professor, I have a strategy on base divergence that I designed. I have a strategy based on divergence that I designed. It is successful 90%, but I haven't used stop loss. I need help to design stop loss in my strategy. How can you help me, Javad? Javad, where are you from? When I come to your city, then we sit down, we analyze your strategy, and hopefully I will help you to identify the level where your stop loss is going to be. And Exxon, can I order buy immediately when I see double bottom? Can I buy immediately when I see a double bottom? You can buy when you see a double bottom, meaning you see two bottoms and price moves above the last top. But of course, do not forget that the prerequisite is a downtrend. Okay, guys, thank you so much. I hope you enjoyed today's webinar. Unfortunately, we have to wrap up here because we have another webinar in another language in few seconds. Please keep on watching your inbox. You are going to receive an email with our next webinars. Go to our website and visit our education menu under webinars and seminars and find the next seminar and webinar near you. Thank you. See you next time.